is actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Bloomberg Daybreak. I'm Alex Steele. If you're still trading, congratulations, guys. You made it to Friday. It was a really unbelievable week, and we seem to be setting up for another day in the red. S&P futures are off by about 0.7%. But factoring in all the information we're getting from different regions of the world, it really could have been worse. I mean, you have a rollover and contraction in PPI over in China, and then you have sort of Italian banks falling completely out of bed, off by almost 5%, despite the fact that you have yields moving higher over in Italy because you may have a change of government, yet everyone's sort of taken that on the downside. If you switch up the board, you can see this huge move in BTPs, yet you're still at 179 for the 10-year yield. You could argue that's not a lot of incentive for the Italian government to kind of get it together. Euro dollar up by about 0.2%. It's a broadly weaker dollar story today, with the exception of the cable rate, now sitting at a 2017 low as the first contraction hit since 2012. The spread here, 2/10s, 9 basis points, and we're still at 1.7 on the 10-year, and we're still holding in around 2,900 for the S&P. And crude, that's really being driven by Saudi Arabia. The IEA calls the market fragile. The Saudis say that they're not going to deliver all the oil their customer wants. That drives those customers to the spot market. Boom, you get instant price action in the oil price. One really interesting thing that happened this week is flows into emerging markets tanked. They're leaving. No one wants to own EM. You can see there the outflows, the daily outflows from EEM. That's that equity ETF for emerging markets. Joining me now is Michael McKee, Bloomberg International Economics and Policy Correspondent, and Sarah Hunt of Alpine Woods is still with me. So, Mike, to set the stage, like, is this as simple as there's global bond yields at record lows, therefore don't buy EM?
Well, and the dollar continues to strengthen, and there's a lot of talk about the possibility of global recession. And you add it all up, and basically, can these countries repay their debts? There's something like $69 trillion worth of debt in the emerging market countries, and there is concern about, what happens if we continue to see the same dynamics play out. We're not at a crisis yet, and other central banks around Asia this week cutting rates to try to prop things up, but the reason for why people are concerned is pretty obvious at this point.
I mean, it feels though it's sort of like caught in a rock and a hard place, because if you want yield, don't you still have to go to emerging markets? But then you have the fundamentals that Mike wasn't talking about.
Well, and I think that's the reason we were just talking about Turkey, and that's the reason why the lira is up, because Turkish yields are still very high, even though Erdogan is now trying to get rates down.
It was the third top performing currency this week, which makes no sense.
By changing out the entire central bank. And I think that it's just very tough when you're in a situation where a lot of emerging markets also depend on commodities for cash flow. A lot of those commodity prices have come down as well. So you have the double whammy of lower commodity prices, a higher dollar, and you've got, if you have enough of a slowing economy, it's very difficult for those economies to outperform. And I think people have been looking at them as a way to get away from the U.S. and other international markets in the hope that there would be growth. But as that starts to slow down, I think people just start to really get worried.
Yeah, we're seeing the elephants dance in the middle here, and everybody's getting splattered.
Well, yeah, and we saw that's a really interesting analogy there. But we saw the rate cuts across, like in Asia, like New Zealand. You have a dovish yielding from Australia. You have Philippines. I mean, how does that play out? Like, how low can they actually go if they're all going to be, in essence, competing against each other? Well,
that's the problem, and that's why you try to avoid currency wars in general. You look at New Zealand and Australia; they're at 50 basis points is where their rates are. They can't really go a whole lot lower till they go into negative rates. And the New Zealand the Reserve Bank of New Zealand talking about studying negative rates and the possibility of doing that. And you get into that kind of downward spiral where everybody's doing that, and you're going to have real problems.
And to that point, I mean, is it only fiscal then? You mentioned it before. Like, is that our only hope at this point?
Well, I'm sort of flabbergasted by the idea that you would now study negative rates, because where has it worked so far? It hasn't really done anybody any good. So I think that you do have to start to think about what are the other options, and you don't want a negative devaluing world to keep going. I mean, there's a reason that gold is sitting at $1,500, and it's not just because people are worried about trade wars. They're looking at everybody essentially looking at a currency fight, and they don't want to be in the middle of it. They want to have something where you have more stability stability. So I think that given the fact that we've had such a protracted period of time with negative interest rates across Europe, and Japan has been very low for a long time, it hasn't really seemed to do a lot of good. So I think you do have to start thinking about other things. But once everybody's going in a direction, it's hard to be a standout, because then you are going to suffer because everybody's going in a direction that you're not going in.
And the conversation that we heard a lot this week was, could the U.S. see negative rates? Joaquin Fells had a blog post. He's over at PIMCO. Here's what he had to say about the possibility of that happening here.
What would it take for negative yields to happen in the U.S.? Well, it's probably not around the corner, but I think what it would take is a serious downturn in the economy, a recession, in which the Fed will take the rates all the way down to zero, will restart QE. And I think at that stage, we may well see negative yields in the U.S. as we are seeing them in many other parts of the world.
Mike, it's crazy that you have the chief economist for PIMCO saying something like that.
Well, you had a constraint on negative rates in the U.S. besides the fact that the Fed doesn't want to do it and would refuse to set a negative rate. But you could see a cost of carry negative rate come into play, except that U.S. bonds until recently were not allowed to have negative coupons. Now, the Treasury Department introduced floating rate notes a couple of years ago when we saw that issue come up, so that they could issue bills that could have a negative rate, and we'll see if they have to do that.
So, Sarah, this is the broader question then, is that if you're looking at your asset allocation or you're looking at regional allocation equities, do you have to then be in the U.S. because we have the longest to go to get to negative rates? Like, literally, what's the answer?
Well, I think, again, this is going to go back to where's the best of a bad situation. And the best of a bad situation still is the U.S. I mean, at least you've got positive economic growth. It's not as fast as it was, but you still have growth. You still have some sort of yield on your fixed income, even though it's a very low yield. It's not as bad as you're looking at across other places. And I think that if we can continue to get some kind of growth out of the U.S., it's still going to be a place that people want to go, and the dollar still is a place that people want to invest in relative to other things at this particular point in time.
All right, Bloomberg's Michael McKee, really appreciate that. Sarah, you're going to be sticking with me. Now we're going to get a quick update on what's making headlines outside the business world. Viviana Hurtado is here with First Word News. Viviana?
Alex, it's a blow to newly installed British Prime Minister Boris Johnson. In the second quarter, the UK economy unexpectedly shrank. That hasn't happened since 2012. Gross domestic product falling 0.2%. Many companies running down inventories built up ahead of the original March deadline for Brexit. British manufacturing falling by the most in a decade. More shots fired in the trade dispute between the U.S. and China. Bloomberg learning the White House delayed a decision on licenses for U.S. companies to restart business with China's Huawei technologies. That move comes